The bank's only going to like my flow if I lose all the time.
What's the difference and how do you provide liquidity and what's going on behind the scenes?
If something's working for so many years, why would they change it? It'd be hard to justify that. It's the backbone of a market maker is their skew. And that depends again on inventory, or if they have a bias, if they think the market's going to go long, they're going to really try to attract sellers.
Welcome to the Your Bourse Podcast, where industry insight meets strategies to grow your bottom line. I'm Elina Pedersen, co-founder of Your Bourse, delivering the fastest matching engine in retail FX and CFDs. Today, we are diving into market making, exploring skewing, liquidity, risk management in the fast moving market. Joining me is Elan Bension, founder of Argamon, a leader in prime broking and liquidity across FX, metals, and digital assets. With over a decade of experience building brokers solutions and guiding institutional clients, Elan will share his experience. Welcome, Elan.
Thank you very much for having me, Elina. Very happy to be here.
I think we've been trying to record this one now for how many months?
It's been a long time coming.
The curse of our podcast. So, Elan, can you please tell us a little bit about your journey into the financial industry?
So it started back in 2006 when I was actually not meaning to get into financial services. I was just looking to get a 9-to-5 job and start getting a little bit more focused on a career. I always liked the stock market, but to get into the stockbroking world was, required licensing, required experience. I ended up landing a job at Citi, and I was working in customer service, and that led me to sit next to the analyst and trading team in the fixed interest and term deposit department. And that got me really interested in the markets. When a role came up for an analyst in the fixed interest department, I told the guys, look, I really want a shot at this. And even though I don't have the experience, and we had about 3-4 month lead time, and they got me trained up and ended up getting the job there, which was awesome. Kind of worked my way up in that term deposit and fixed interest division. Then we got moved to another floor where we were right next to the foreign exchange division. And that's where the whole journey started for me. I just got obsessed with the guys over there, with what they were doing, with the volatility in the markets. And that was coming into 2008 as well, when there was a lot happening. So that's really how I got my first exposure to the industry.
Okay, and how did you end up here? How did you end up in retail effects?
So in 2008, 2009, obviously Citi went through its headwinds in the media, and there was a lot of back and forth regarding their solvency, and a lot of the clients that we had, especially building a fixed interest and term deposit book, became volatile. A lot of them left, and there was just too much pressure. I wanted to get into the FX department, but I couldn't tap into it at Citi. So I decided just to quit and learn FX for myself and see where it took me. And I was fortunate enough to meet the guys at Axie in 2009, 2010, became an IB and brought over actually quite a few FX clients from Citi over, and a bit of myself. And we were mainly doing physical currency exchange, so moving money for importers, exporters, and guys that wanted to trade. And that's how I kind of got into the retail FX space. That was the initial point. And then in 2012, we launched with my business partner, Jeremy, Global Prime, alongside a company called Gleneagle Securities. And that really was the kickstart of our career in retail FX, and then also FX prime brokerage.
Okay, so what would you say was the pivotal moment? The Citi or maybe something else?
I think the pivotal moment was, someone coming up to us, who we're very grateful for, and saying, hey, look, we don't have the means to kind of, or focus to build FX, but we have a prime broker, we have the technology, we have an MT4 platform. Here's the keys. I think that was a pivotal moment for us, an opportunity that was handed down, which, is kind of that once in a lifetime opportunity where you just got to grab it. That was definitely the pivotal moments. for me. Yeah,
But Argamon is something different now. Is that correct? And
that is correct. That is correct. I think Argamon was born out of the need to really simplify institutional access and move away a little bit from the retail side and really focus on the prime brokerage and liquidity, as well dipping into digital assets, offering tailored infrastructure, really focusing on execution solutions for brokers, funds, traders. We also, it was a natural pivot from global prime when we stepped out of that business. And in order to kind of get the credit with the prime brokers as well, we really needed to separate ourselves from that retail side.
okay, so Argamon is a market maker, is it?
Yes, we are a market maker. We offer prime brokerage solutions, and we do what we can to provide better solutions for our clients.
Okay. So I don't think that often you would hear someone in the industry say, "Oh, we are a market maker." I think there are a lot of benefits to working with the market maker. Could you please explain, like, what's the difference and how do you provide liquidity and what's going on behind the scenes?
Yeah, sure. Look, with a basic form of a market maker is we continuously stream bid offer prices, and we effectively will internalize or take the other side of the client trades. That will, depending on our own inventory, we'll offset it with our inventory, or we'll go out to the market and try to source that, and try to exit those trades passively as quick as possible.
Okay. And so what would be the difference between like a B-book broker, a standard typical B-book broker, and
Yeah.
your model?
So look, in a market making environment, one things we have to get right is, we build real time pricing engines, we have real time risk checks, we have logics for internalization, different routing logics to go to ECNs, to go to for example, the CME where we might offset risk. So there's a lot that actually goes into market making. I guess the key is more inventory management, spread control. I think that there's, the other two comparisons would be an SDP broker or what you classify as a bucket shop or someone that just internalizes. So a real market maker is going to hold inventory. They're going to internalize, and we're going to profit from spread mainly and from flow optimization. It also means that we have the means to offset our spread very quickly, which means that we're not too weighted on a client to close his trade. We more look at on a trade by trade basis where someone internalizing or B-booking are reliant on that client, the open and close leg of that individual client. And if the client will, let's say, go into profit after 4, 5, 10 minutes, that could actually be a toxic client for a B-book broker, where for guys like us, we'll take that on all day. I think that's where the real difference lies. And obviously an SDP broker is you're just passing the trades directly to an LP. There's no exposure. There's a lot of benefits to that. We ran that model for well over a decade and it worked really well for our business.
So why did you decide to move away from that?
We wanted to be able to increase, well, two things. We want to increase our profitability because being an SDP broker has its limitations. We're only capturing spread. We're not able to capture any sort of, risk from market volatility or from any specific type of trading. But the second thing as well is being able to also customize the execution for the client. Banks are only going to do so much optimization for us or for any individual client. Most of the streams that you get are probably shared across multiple brokers and multiple different counterparties. We saw that when we had clients that would open our account, that open accounts with us, especially of size, and would want to trade large sizes. Sometimes they are trading through multiple accounts, or they're just trading large sizes. And when that hits an aggregated book of liquidity, say, for example, a client wants to trade a 3,000 ounce position. If my top of book stack with an LP only has 100 ounces or 200 ounces, we've got to start hitting systematically every single quote on that book. And what that does is it sends a message to the market that, hey, there's a big order coming through, there's a sweep, could be machine gunning. A lot of defense mechanisms then get get activated. For example, liquidity reduction is a big thing where a bank will accept it, but then they'll widen their price instantly. And what happens for the client is that he might not be predatory or toxic. He might just be wanting to execute a large order into a retail stack, and that inherently comes with latency and slippage. So being able to provide our own two-way quotes based on inventory or based on our ability to exit that, passively somewhere in the market improves the execution for clients and their overall
And it gives
experience with
you,
us.
a bit more flexibility as to what kind of clients you can onboard, which makes
Exactly.
a lot of sense. And thank you for explaining that. And I love your explanation about the difference of being able to capture spread, and honestly just sitting on exposure, which is
Yeah.
some B-book brokers are used to.
Yeah. I mean, on that, where at the moment we've been talking to a number of larger clients. I won't mention the name of the broker they go through, but there's a prime broker, an institutional prime broker out there that effectively just B-books. And any client that is exhibiting profitable flow after 3 or 4 minutes, it's not just they don't put them onto another stream. They shut the account down and they say go somewhere else. And this is a prime broker. So it's great because a lot of these places are moving even towards that. I thought that it would go the other way over time, but it seems that more are going towards the internalization again and the B-book model. But that works really well for us because then the clients come over and they say, can you take this flow? Are you going to turn us off? And the answer is always, yes, we can take your flow, and no, we'll never turn you off. So there's definitely opportunity there.
So how much, if you can answer that, of course, I'm just benchmarking here. How much spread are you expecting to capture on like a standard flow,
You'd be lucky. It depends how aggressive we are. And it really depends on the type of client flow. Usually the maximum we're going to sit on risk would be about 10 minutes. And there are certain
Okay.
clients that exhibit that type that we can hold it. But I would say majority of our book and even the retail flow from our retail brand is mostly flat. So it is
Okay.
in my opinion, it is getting tougher to manage for someone internalizing to actually manage that flow. They have to get really good at classifying their traders. And usually that comes at a price to the actual trader. But for us, flat works really good. I mean, flat on a markout curve, because that gives us time to go and offset that. And the more patient we can be, the more time we have to hedge risk, the more spread that we can capture. So someone that's we classify as aggressive, which might go negative after 30 seconds, we're very lucky if we make $5 per million, and we're very happy to make $5 per million because then we charge commission. There's a swap business if they're holding positions overnight. And someone that is exhibiting really good natural flow, which is, let's say, positive out for 10 minutes, we could extend that to $10 to $15 per million. And that is a really good yield. Yeah.
And for example, would someone with 30 second spread decay, sorry, still very early, would that potentially ruin your relationships with your counterparty, or would they be comfortable with that?
So again, what we'd aim to do is exit that risk passively, which means that you don't
Okay.
really have, because we'll actually go out to CME, we'll go out to ECNs. We even use bank algos now. So there's a couple of banks that have given us algos to use where if we just want to get out of that risk fast, we send it to them. They look at their internal book and they offset it. If they feel that the market is going against them or us, they'll then go aggressive. And usually on average, we can get out at mid with these algos. So we end up saving on the execution. It's not really a profit center for us, but it's a great way to exit toxic flow really quick, and you don't get any complaints on that. But going back to like exhausting that flow to liquidity providers, we still do quite a lot of it. There is flow that we just don't want to take. I think banks are more concerned with skew leakage than they are with, I think, toxic flow.
Okay.
That's just what we've seen. But because we also have a very short-term risk basis, we still SDP a lot of flow to the banks. So there's still a lot generally that we leave on the table. And that's because we have very strict VAR-based risk. So generally when those levels get hit, we're also aggressively hedging out. No matter how good the flow looks, we'll still get out of that. So maybe that could be a reason why they're more tolerant with us to take some of the tougher flow. But I think, in my opinion, everything's tagged that we send to them. And I really feel what they really care about is skew leakage.
Okay, so I think there were three things that you said in that sentence that would be interesting for our audience. And exiting at mid-price, I think that was the first thing I'd like you to expand on. The second one was skews and, skew leakage for banks. And the third thing was VAR, so value at risk, I assume. So it would be great because I see that a lot of brokers, they still, especially with mid-price, I don't think they quite understand how it works and how it can be used. So could you expand on that
Yeah.
when you look at your risk portfolio?
Yeah, sure. So if we go back to the market making side, if we need to get rid of, so if we've got a client that is generally offside after 30 seconds or a minute, what we might do is when we go and sit passive at various order books and ECNs or whether it's futures, if we only have 30 seconds, we don't really want to sit on the opposite side of the bid or offer. We'd want to go inside that spread, which would effectively be at mid. And hopefully we get out with capturing a little bit of spread from the client, but a lot of the time you're really getting out at break even. So exiting mid is really a function of how aggressive. As we become more patient because the client flow looks a lot better, we can sit on the opposite side of the bid offer, or even one tick wider or two ticks wider, depending on how long, and hope that a sweep comes and we end up getting paid a bit more. And then the purpose of bank algos is really if you can choose, again, different settings. And we use bank algos for a really toxic flow where we know that we want to really get out of that as soon as possible and at mid. And so we'll choose an aggressive setting with those banks and send them that type of flow. What was the second question? I think that was that around skew
Yes,
leakage?
I will.
That was around.
I will give
I think that was.
I will give you this. Okay, that's the second question, but I'm just going to explain to the audience one thing. So I think, and this is where the benefit of Argamon really is, because not a lot of liquidity providers in the industry actually have the ability to place those limit orders onto the ECN. So it has to be someone, you would have to find someone with a relationship with ECNs that would allow them to ultimately, as you said, offset your exposure with limit orders and passively be in that order book. I think that even a lot of technologies on our market don't have the ability to allow participating in those liquidity pools, really. The second question, Elan, was about skewing.
Yeah.
So can you tell us a little bit about banks and how they skew and what you do when you see a skew?
Yeah, so I guess skew is when prices are adjusted to reflect market bias, client behavior. Like example, you'll widen your bid if you're long inventory. You'll try to capture clients that are selling, and effectively you're buying. It can protect against adverse selection. It can incentivize flow in the opposite direction. So it's really beneficial. It's the backbone of a market maker is their skew, and that depends again on inventory, or if they have a bias. If they think the market's going to go long, they're going to really try to attract sellers. So what they'll do is they'll start stepping up their bid. And that can become a very competitive environment when you have a number of market makers, and that's where you usually see the spread start coming down into zero or even inverting. And it could be very beneficial to someone who is taking liquidity and executing with banks. I guess the reason why banks would be afraid of or concerned about skew leakage is if a taker or a HFT or, in participating in an ECN, or even sometimes they disguise themselves as clients of the broker and you give an API and you send through your bank pricing to them. What they'll do is they'll build a panel and they'll start to see what a HFT might do is have a neutral source, a mid reference from LMAX, from ECNs, from CME, and they'll start overlaying these prices coming in from us or from a broker, and they'll be able to see when certain prices are starting to skew, and that can infer to them that there's a large player active, that there's information that no one else is seeing, and usually the banks will put their skews in order to kind of start to attract the flow in the direction that they want. That can lead to front running or information arbitrage, and the banks don't like that because if the banks are trying to go a certain direction or they have certain inventory, the last thing they want is others in the market to hear about it, to see it, and then basically put their orders in front of them. I think it's one of the most serious things at a bank. Well, in the 10, 12 years of me dealing with tier one banks, that's, I think, been on the top of their list. And what we employ to mitigate that, we've had all these issues in the past. We dealt with skew leakage from a number of banks for a while because it's hard. You're aggregating liquidity, you're sending it to clients are opening, and you're like, great, clients open an account, they want an API, they're depositing money, it looks good, and then the next thing you know, you've been pinged for skew leakage. And the worst thing that can happen is there's a 3-strike policy. On that 3rd strike, the banks will remove that skew. If they remove that skew, you've lost your spreads start to widen. You don't really get those benefits, and your cost to hedge becomes a lot more expensive. So what we've employed is we get the banks to provide us non-skewed streams alongside using ECN references, CME reference. We build our own mid effectively. So all of these streams that the banks give us, they never actually get shown to any clients, not even to our retail book. What that allows us to do is we price off the back of these non-skewed feeds, and we can artificially tighten them, bring them in and adjust them to what we want so the client sees the spread that we want them to see. But on the execution side, we then go, and when we're ready to hedge that risk, we go and execute with all of these dark liquidity providers or skewed streams that are provided. So it protects the banks. It enables us to also obtain price improvements, which is great. And the third thing is the banks feel comfortable providing these streams because they don't have a risk of skew leakage. So it's taken a while for us to get to that stage. We've recently, I think, over the last few months, really pushed ahead with this strategy, and it's working really well.
Oh, fantastic. So then would that be called a skew safe environment, or is a skew safe environment something else?
No, I would say that's a skew safe environment for the banks because they have comfort knowing that their prices aren't being shown to the wider market. So yeah, definitely. Then there's also the concept of a skew safe stream. A skew safe stream is a stream that doesn't actually contain any skews, and it's safe to publish to whoever you want. Yeah.
So would a bank then provide several streams and say, okay, this is a skew safe stream and this is the stream that only you can see?
Yeah. Okay. Yeah, exactly. We work closely with a company called Reactive Markets. They're quite amazing. They basically have most of, if not all, the tier one banks, non-bank market makers plus brokers. So it's one API integration, and the pricing is really, it's free for a broker to take liquidity. So there's no additional cost. And the banks will give us however many sessions we want through them. So they connect up to all the aggregators or directly to our pricing engine. And then we just have the credit with the different banks and non-banks, and we can just set up all the pricing we need. And we'll request 2 streams to start, non-skewed and skewed. The skewed stream stays dark. And then if we need, sometimes some banks go, hey, you've got some institutional business, let us give you another dark stream. So can give us 3, 4, however many streams they want. That helps them manage the risk better.
So would you say that like skewing today is more an automated process than a manual process? I think everything is automated these days, isn't it?
Yeah, I would say so. Definitely automated. And it happens over milliseconds. Markets change within microseconds, so they have to be able to react to it. If you are slow, if a bank is slow, that just gives rise to latency arbitrage. I think we have spoken on our last podcast about the effects of aggregation and having too many banks on one feed, and that's really the cusp of all of these brokers that we talk to that come to us and say, hey, we can't manage our liquidity, we're getting arbitrage. It's basically from latency up. It's where they're streaming in so many different quotes from 4 or 5 other primes, and these guys are coming on and saying this quote's 5 milliseconds late to a feed that they're getting. And because these brokers are internalizing it, it's a quick arb for the broker, for the client, and that stuff needs to be managed in real time.
And what kind of signals do you think go into those skewing decisions or algos?
I think that it's client behavior, and that really depends on their markouts at the end of the day. I think market conditions, so your like implied volatility, book imbalances between in internal books. That goes to my next one, which is internal inventory levels, even cross asset correlation data, which we don't really dive into, but the banks all do. And yeah, these all kind of go into creating, their signals and their information, their bias.
Okay. So when you say markouts, I mean, we briefly covered it. We didn't really expand on it. But I'm just wondering, did you say end of day markouts? Or was it like
No, I think it was
at
more,
the end
I
of
didn't
the
say
day?
anything. I said win rates. At the end of the day, win rates,
Uh,
for the bank, markouts are super important. And those markouts probably don't get beat. They're not reviewed real time. They're not probably not reviewed end
okay.
of day. Probably reviewed by like fortnightly or monthly. We review with our banks every single month their share. At the end of the month, we
Okay.
have a conversation and we talk about their market share. We talk about the markouts, and that really helps. See where we've actually got automated reports that goes out, and they can see their ranking. They can see how they performed on every single asset. And it's really good for them because they pick up things that, and they end up contacting us and saying, hey, our share has gone down on Aussie dollar. We've noticed that, look, we've tightened up to hopefully capture more flow. So as much information you can feed to the banks as well, the better. You get a lot more back when you're proactive about it.
Can you expand? Well, I hope our audience knows what markouts are, but maybe you could give us a definition.
Okay. Yeah. It's a look at a timeline that is has different intervals in time and then plotted against the dollar per million. So what we would look for is at inception, you should always be positive. So that might be your midpoint spread, which might be $10 or $15 per million. And over time, if that markout is increasing, it will show that the client trade is actually going against them and for the broker. If it's going strongly up, if it's going down, it means that it's usually going against the market maker and the client is in profit. That could be very controversial. For some when they hear it, it's like, well, the bank's only going to like my flow if I lose all the time. And look, yes, banks do. Everyone likes flow that consistently loses, but it's not always the case. As I said before, our retail book exhibits quite flat, a nature of flat markouts. And yeah, that really gives an idea of the profitability of the client. And really what banks don't really care about an upwards facing. We don't really care about. We're like, great, if that we're not really sitting on risk for that long to want to capture that much of a spread. Really why it's important for us is we can pick out clients that are offside very quickly. And it also determines our hedging strategy. So our classifiers, which we use with Mahi, automatically classify clients based on markouts. So instead of us having to manually look at our clients and say, oh, he's not great, he's trying to arbitrage us, or he's, going offside within 10 minutes, it gets done automatically. And all it means is we still accept the client trades. We still trade. We still accept their sizes. We've got a very competitive top of book and depth as well. But it determines how we hedge it. And that's, when we spoke before about whether it's a bank algo, whether it's ECN, whether it's CME, and it's also how aggressive we have to be when we exit that risk. So markouts are the backbone of our business and market making.
I think it becomes a lot more popular, or I'd say more brokers are starting to look at markouts or use markouts in their risk management. When we spoke in March, we just released it for all of our clients, and now we can see that more and more clients are using it, even if they're
Yep.
not in liquidity provision, but they start to understand that it's worth looking at, because I think a while back it was only the banks who would look at markouts and spread decay in essence. So I think it's great in a way that the industry is getting more knowledgeable.
Yeah, they
but
are. And it's, yep.
Yeah, go for it. Sorry.
It's a great way, like I said, to be able to understand who your client is and what they're trying to do, and then make an informed decision. Again, a lot of decisions I think in brokers are made manually. Automation's key if you really want to stay ahead.
So let's define sharp flow then. So far, everything is possible. And as long as it's a spread decay of more than 30 seconds, we're good. But what would you identify as a sharp flow?
I think sharp flow that's consistently profitable, but not when I say I shouldn't use that term. I think I'd call it more unhedgeable. And again, what sharp flow can be defined differently across, many participants. A bank will classify someone as sharp that goes negative within 30 seconds, similar to us. A B-book broker might classify someone sharp that goes negative within 10 minutes. But it's really someone who's consistently profitable at that time zone or at that time frame, or very predictive. They may have information as well. There are a lot of participants out there that will go to many brokers and open up accounts that have that information. They either have skew pricing from banks that they're using, and they don't leak it, but they'll use it as information to then go and hit a buy or sell at different brokers. I think the most popular one is having access to a futures feed, a CME feed, because they tend to be at the forefront. They tend to be the fastest. That's really, what consists of toxic. But again, different LPs have different thresholds. They have different tools for identifying sharp flow. It could be, and those tools can be based on, how they identify it is based on hold times, markouts, and how difficult it is to hedge.
Okay. So would you think, I guess you said that it would be different for, let's say, banks, or for yourself, or for typical back-to-back liquidity providers? So they would classify it differently.
Everyone would have their own way of classifying it. I mean, an SCP broker, they're just going to have to deal with complaints from banks if a majority of their flow becomes toxic. That's something that we kind of went through as we were building Global Prime. And we didn't have many clients at the beginning. We found that a lot of that flow was toxic. As we started to grow the base and grow the book, it started to blend quite a lot. So, it's based on a few variables.
I assume that when you speak to clients now, sometimes, or most of the times, you could probably say straight away if the flow will be sharp based on... Yeah.
Give me five
based on what
minutes,
they're asking
5
for.
minutes or less.
Really?
5 minutes or less
So
with a client.
What would be the
I think
typical questions?
I think when the typical questions is how quickly are you opening and closing? Can you send us trade data? That's usually before the call. We'll ask for trade data. Do you aggregate any liquidity from different sources? But usually, how often are they opening and closing? Because generally a lot of these guys are coming in and they're really just trying to basically capture when the market's spoofing or moving very quickly. They're trying to take advantage of a late price. And sometimes it's harder to tell because they'll open with you and then close with another venue. So it's hard. You won't see the close straight away. And also it's just a feeling you get from talking to the client. Usually they're just small groups, like one-man shops. They're running an algo or a small fund or whatever it is. And but I think the data is the dead giveaway. And usually when they don't want to give the data, you kind of know pretty quick that, it's probably not worth to pursue.
I just looked at our statistics for June, and in June, 83% of all trades that went through your Bourse were gold and metals, not just gold, metals, right? But in general, gold. So I'm assuming you see similar patterns?
We do. We definitely see similar patterns, and we're actually onboarding a couple of brokers now that the conversation has only been based on gold and a couple of CFD pairs, equity index pairs. But we talk to brokers and clients these days, and just like you said, 80-90% of their flow is gold. It's crazy, and seems to be a lot of it coming from Asia. I think that like regional flow behavior varies. I think with Asia, flow heavy, short hold times, very informed. They will go in droves and communities. They'll have obviously a wider network, and what they'll aim to do is when they're going to hit 5 or 10 brokers at the same time and overwhelm that. And what they're really looking for are they open accounts, and generally with a B-book broker, when an account's open, they will set it to B-book. And these guys don't have to fund big sizes to make big money. They could fund with 5,000 because they're instantly on site. And it's really interesting because when we onboard clients, we've got IBs that are always sending us flow, and some of the first things we'll always get from the IB is, oh, he's getting slippage. And so we'll look at it, and they might have tested with, let's say, 200 trades, and 100 of those 150 of those trades, this is in their testing phase, will actually look really good and they get filled perfectly. But then those 50 trades, we pull up a tick chart and they are trading at the exact millisecond before a drop of, let's say, 50 cents to $1 on gold. And I'm talking because what they've done effectively is they've got a faster feed. They're seeing the market's going to move. But because we employ a last look and a hold time, again, if you're trading, and it's quite a generous last look and it's quite a general threshold of how much we tolerate. And we've really defined and we've tweaked that over time to reject the right trades. And you'll see that, and I show them tick charts. I'll send them a screenshot where you can see an X where we rejected it, and not even a millisecond, 50, could be microseconds later, the market started to move down. There's nothing you can do for a client like that. And that's what I mentioned before, unhedgeable, because you as a broker or market maker or bank are going to be offside. There is a case where we've seen some non-banks want that flow because they actually use it as information as well. You'd be surprised, but a lot of market makers use toxic clients for information. So what they'll end up doing is offer a small amount on the top of book for gold. It could be 100 ounces or 200 ounces and allow them to hit that just to get the information. Information's key. Like I said in the beginning, skews are based on client inventory, client flows, not just the market and internal inventories. But client order books can contain a lot of information and can be of use as well.
I think those providers have also a reputation for it. So I assume it would be probably difficult for them to get access to good liquidity.
Yeah.
I'm just assuming that.
Yeah. And again, the clients that we're talking to that are struggling with this is they're internalizing, and it's that they don't have real-time risk management. All they do is they have end-of-day data that says, okay, we just got taken for 100 grand from this new account. The next day they switch it to STP. How do you stop them in real time? And I think that's where the last look comes in. That's where the automated classifiers come in. And like I said, there's technology providers like Mahi, for example, that do a really, really good job at that. You have to be real time these days. Like you can't take risk. And because if you react to it a day later, like you've already lost. It's done. They made their money, and they shut the account down and they reopen under another name or with a different broker, and they just keep moving.
Must be a difficult job. I mean, to just keep moving and hope that you won't be noticed.
It's terrible. And it is terrible. And they're really struggling with it. Yeah.
So you've mentioned last look as a protection mechanism a few times now. So what's last look? And I know that some major banks have different types of last look of how they look at the ticks.
Yeah. And some of the major banks like your UBS, JPM, they're incredible. Like their last look is a millisecond because they're so confident in their pricing and their, how they skew that when we hit them, they genuinely want to be filled. But last look is a delay that an LP can reject an order after receiving it. It will consist of a hold time. So depending on, again, the nature of the flow, the nature of the clients, it could range from 5 milliseconds to 100 milliseconds. In digital assets, in crypto, that could go up to 200 milliseconds. Then you've got a threshold. So what tolerance? So within that last look period that you have, how far away from the price are you allowing the price to go before you reject it? And that could be 1 basis point, 5 basis points. It could be whatever and again, that component is manual. That requires a little bit more analysis on the classifiers and the groups of clients that you're pricing. So we have different channels and execution logic for groups of clients, and they each have their own last look settings. So your typical guy that is not trying to arbitrage, that is just systematic, they're trading, or a retail client, the last look it's virtually instantaneous. Whereas someone that is trading gold, someone that we know that might try to take advantage, will have more stricter rules. The great thing about that, it's dynamic, and it means that I think brokers only have the ability to do it across the client as a total and across all of their trades. And sometimes in order to stop it, they'll just employ a random slippage that applies to all the trades. Whereas with us, sometimes with some of these toxic clients, they stay with us because 50-60% of their trades are still getting filled, and maybe they want to get filled at that time. And again, like our fill rates with our retail clients in general and with Afterprime is 99.9%. So we're filling everything generally at the levels that they request. So this last look is extremely important. Yeah.
So within that last look interval, I would say that the traditional retail brokers, what happens, and we can't really call it a last look, it's more like execution delay, really. But what happens is that they don't really do much, right? They don't really look at their own inventory. They don't really look at the ticks in the market or the liquidity. So for those banks who offer 1 millisecond, sorry, what do you think they look at within that millisecond? Is there anything that they can see in that millisecond?
I think as I said before, like we've seen, some traders trade within that millisecond. But again, the reason why they give us virtually firm feeds, and maybe it's just a compliance policy that they have to have something there. I don't know.
Okay.
But because they've worked with us for many years, we get that. Whether or not every broker has that with the banks, I'm not too sure. But again, 1 millisecond, you're right. It can, it might be enough to force a last look on some of the most toxic clients, but yeah, my guess
Yeah,
is
it
when they're at
seems
one
like no
millisecond, you
last
might
look.
as well be at zero. Yeah,
Yeah,
exactly.
exactly. All right. I think another thing that we see a lot, and that, as you said, there is for those liquidity providers who are happy to accept toxic flow as a signal, you would see that their top of the book would be very thin, and you would also see that there would be a lot of speed bumps potentially when
Yeah,
clients try to trade. So do you
yeah,
employ any speed bumps? And could you explain a little bit about speed bumps, please?
definitely. Speed bumps are important. Again, it's important to classify because in the close to the beginning of our chat, I spoke about when there are some clients that we have that run multiple MT4 accounts, or they run signals for their clients. So we might have 20 or 30 accounts that are trading at the same time, and they're not necessarily toxic. And what speed bump or liquidity reduction actually does is, I'll say I'm gonna build up on a single trade. If it's greater than $500,000, once that gets consumed from my stack, I won't replenish that 500K at that top of book price for 1 second or 3 seconds. If they trade, and during that time, if they trade, I'm going to make sure that the price is worse off by $20 per million. So if they try to do another 500K within that 3 seconds threshold that I've set, they'll receive a slippage of whatever I set it to. What it's there to do is really to protect you when you're building your own order book and you're quoting your own price. Again, if you're just blindly internalizing, someone could sit there and hit, and within 10 seconds, they could have built a huge position against you with no recourse, and you've given a top of book price. And that's really to protect it. So to protect ourselves. On our retail, for example, that threshold is really high. So I think it's something like 2 or 3 million before we have any sort of liquidity reduction. And that, suffices for majority of our traders. For our larger volume traders, they're on a different classifier. If we know them, if we understand their flow, then the liquidity reduction is going to be less because we actually want to attract large sizes. And they might say, hey, look, I'm a money manager. I'm managing 10 different accounts. I don't want to use a MAM. My clients want individual accounts, and I'm going to hit each account 500,000. I'm going to build a $15 million position within 10 seconds. And the great thing is we understand that flow. So we might go, all right, liquidity reduction or our speed bump is only going to be 10 million for this client. And then we'll employ strategy, which will be straight away send half of it to an algo. And straight away, depending on the markout, that'll determine how aggressive we get on the passive side. So speed bumps, extremely important. I think that is where the issue with STPing is because when you are sending a large order to multiple banks with just small topper books, you're going to consume whatever they have top of book. They're gonna turn off that price for a couple of seconds, and you're going to be reliant on someone that's wider. So, and a lot of the time, what will happen is the same bank will be pricing wider, knowing that they've just consumed one part they force that price wider, knowing they're going to get hit on that, and that's extra spread. So yeah, yeah, that's a bit about it.
With speed bumps, I think you've answered it, but I'm just curious. So would you say that it's a few seconds that it would take a few seconds for the price for the top of the book to refresh, or is it?
It like on for our retail clients, I think we refresh it again within 500 milliseconds or something. It's super quick. I think most banks are around that time, sometimes shorter. We don't really analyze that too much, but I would assume it's usually less than a second.
Unless it's all being swept and the market is moving
Yeah.
rapidly, and
Well,
then you
yeah,
go like, oh.
and then that's where and that's where the volatility kicks in. That's where the spreads start to widen. If it's sustained, it'll just stay wider for longer, and that's how it protects the market makers.
I have a bit of a surprise question for you because I just came up with it whilst we were talking.
Sure.
And it's more about the funded phase for of the prop firms. So do you see a lot of that flow of those funded accounts that are amazing at trading and pass all the amazing challenges and then they end up being funded?
Look, we don't engage too much in prop. I think it's something that After Prime's looking at.
Okay.
I've spoken to a number of prop firms that are struggling as well with, against arbitrage and informed traders. And I think as soon as you start to mess with the model and say, I'm going to classify this and I'm going to SCP this, I think the whole thing kind of starts to break. I wish I could kind of answer more about it, but I don't know too much about that industry, only that it is huge and growing rapidly. Yeah.
I get a lot of a lot of prop firms that we work with, they are asking for a reliable source of liquidity
Yeah.
for their funded phase, because
Yeah.
a lot of it's it's a bit of a chicken and egg problem, because if their clients passed the challenges because they were essentially toxic, they won't be able to achieve that in the real market, so to say. If they didn't pass because they were toxic and they actually followed all the rules, then they need a reliable source to ensure that as much can be filled as possible. But again, then when
Yeah.
they STP, then they have question of paying for it as well. So it just becomes very, very difficult to manage.
Very difficult.
So,
Yeah.
thank you. Is there anything else that you can think of that we haven't mentioned? And this has been incredibly insightful, Elan.
Thank you. I think maybe just looking ahead a little bit and, seeing, what the future might look like.
Yeah. Do you have a crystal
and I
ball?
think,
Share with us.
well, I think obviously the rise of prop style copy trading, that's one thing we know for sure. But I think, the growth of like cross asset liquidity, FX and crypto together in metals, we're getting a lot of demand to create synthetic pricing for different brokers, especially coming out of places like Japan. There's not many market makers in the digital space which are creating, for example, yen crosses. The majors are easy to source, but some of the other cryptocurrencies, it's very hard to get pricing in different currencies other than USD. That's something we've been actively doing for a number of years and getting a lot better at it. So we're getting also talking to ECNs like Fastmatch, 24X. They're reaching out and saying we've got demand for INR against Mexican peso, or we've got demand
Okay.
for Aussie gold, Euro gold, CNH gold is quite a big thing that we're seeing now.
Okay.
And I think your ability to create this is something that you can't get from liquidity providers. It's very hard to find a broker or a market maker that's willing to stream you that. One of the benefits we have is we can create products out of anything. And I think we're trying to work out the cross market from NDF to spot. There's a lot of demand there as well. We're getting asked a lot to create that. We're still trying to work that out. And then finally, I think that the passively hedging is something that I think needs to grow in the industry. And I think brokers need to kind of become a bit smarter in terms of how they hedge. They're paying so much away to execute. I think one of the most exciting products that have come out this year, which I haven't heard much about, I think is being downplayed, is CME's new product, Spot Plus,
Yeah.
which
Yeah. Yeah.
is basically access to futures markets through your spot PB. So we can make into the futures markets now through Spot Plus without having to have our own futures PB set up, without having a cross margin, then have huge margin requirements that you'll have with the CME. It gets converted to spot, but we get to passively make directly into the futures market. So we've gone from taking, 5 minutes to hedge a trade at times that could be seconds. So I think like there's a lot of really cool products out there that are helping brokers to execute more efficiently. And I think people need to do their research. I think tech providers, need to also even step up a little bit and think about employing some of these within your systems. Last look could be one example. Giving clients the ability to maybe working with some of the banks with their algos. So integrating algos into the aggregator and allowing your clients to send orders that will automatically get converted to a mid order at an algo, and giving them the ability to execute cheaper. I think the tech providers, I think that there's a lot that they can do to help their clients. Yeah.
Elan, it's so disappointing because we've added so many features that you're describing. I mean, last look is not even something like it's been there for, and the different types of last look, depending on the inventory, it's quite flexible how it can be set up, but people don't use it. Same as like, I'm glad that Markouts are being used now, which is, again, I think a massive step forward. But there's so many features in the system that we've developed because we thought it's going to be a massive benefit or added value, and people don't use it. But okay, we're quite fortunate. I must say we're quite fortunate. Like our clients or our segment would use majority of the tools we provide, but very often when we talk to clients, all they care about is pricing. So they're happy to spend millions on marketing, but the technology that could actually ring fence their bottom line, they don't often see a value in like having those tools, unfortunately.
It's surprising to me because it's so much that, even just the last look feature, I think is game changing for brokers that are internalizing most of their flow. It's like a first line of defense against toxic flow. That seems crazy to me. Maybe I kind of was right when I said that. I feel like the industry might be going a little bit backwards and be looking and internalizing more, but yeah. I think you guys are doing. I was going to say you guys are doing a good job because a lot of these products, I haven't heard of other technology providers that actually employ that. So that's really cool.
I wanted to ask you one last question, really, in regards to what you said about having access to vendors such as CME. Why do you think brokers are not actively exploring those opportunities? Like, why do they still do the same thing they do?
I think it's very small. One, they don't have a prime broker. Getting access to a prime broker these days is extremely difficult. Prime banks will usually assess the amount of risk a counterparty's taking on. So no matter how much they have on their balance sheet, if they're taking the risk that they're taking, they generally won't onboard. And plus, I think these guys are doing what they're doing best. They know how to market. They know how to monetize. Yes, there's volatility, but they do make money over periods of time. That's what they're good at. I think to try to force a change, to start stepping in, also even potentially giving away some of that profit in order to smooth the volatility and create consistent P&L. It's a big change for these guys. If something's working for so many years, why would they change it? It'd be hard to justify that.
Yeah, and flattening the curve is a scary concept for them.
It's a very scary concept for them. Yeah, exactly. Yeah.
All right. Thank you so much. I think it's been very insightful. I'm sure the audience will enjoy it. Thank you for sharing your knowledge. And where can people find you? LinkedIn?
LinkedIn mostly. That's definitely send me a message. If you just want to have a chat, want to understand the markets a bit better. Always available.
Okay. Well, I must say like, share and subscribe, right? As we must.
Definitely.
And thank you for joining us.
Pleasure, Elina. Chat soon.